Hi everyone, I'm Ajit Jain, partner at AJMS Global into transfer pricing. Welcome to this podcast series on transfer pricing. Transfer pricing is one of the most important international tax issues, and in this podcast series, I'm going to discuss various practical aspects of the transfer pricing, focusing on Middle East region. Now, this first podcast is on fundamentals of transfer pricing. Before I talk about the fundamentals of transfer pricing, it is important to mention that transfer pricing is not a subject of compliance only, it's a subject of law, it's a subject of economics and subject of negotiation as well. And that's the reason it is said that transfer pricing is not only a science, but it's an art, mix of negotiation and strategies, finding a common ground. Now, when we talk about the fundamentals, it is important to understand what is transfer pricing. Transfer pricing is basically a price charge between the two related party transactions for transfer of goods, services, intangible, or even financial transactions. But why there's a need of transfer pricing regulations? A number of countries across the globe have introduced the transfer pricing regulations. Tax is an important source of revenue for any country, and no country would like to see any sort of base erosion from their tax revenue. And that's the reason tax authorities across the globe are concerned about getting this fair share of tax revenue. When the two related parties deal with each other, they are not affected by the market forces. And there's always a possibility of price adjustment because they are part of the same group. But when two third parties deal with each other, their price is affected by the market forces. And that's the reason the transfer pricing regulation ensures that the transaction between the two related parties are at arm's length, which means as if the transaction is happened between the two unrelated parties. And that's the objective of the arm's length, that there should not be any profit shifting from one jurisdiction to another jurisdiction. When we talk about the transfer pricing regulations, there are few aspects. One is the arm's length principle, which ensures that the transaction happened as if the transaction between two unrelated parties. The second aspect of the transfer pricing regulation is the substance. Even if the transaction between the two related parties are at arm's length, it is very important to justify or substantiate the rationale of the transactions. If any payment is made, say for example, royalty payment is made, what is the rationale of that payment, irrespective of the fact that the royalty is at arm's length comparing to the unrelated party? If there's no enough benefit is availed, the tax authority might challenge the transaction. So substance is a very important part. And the third aspect is the fairness and the transparency. Wherever the transfer pricing regulation have been introduced, there have been a significant improvement in the overall efficiencies of the multinational companies because the transfer pricing regulation ensure that the transaction arm's length, and which result into a great level of efficiency in terms of building the transfer pricing policies, systems, and processes. So transfer pricing regulations is not just about avoiding shifting a profit or from one jurisdiction to another jurisdiction. There are other aspects as well. Now, another area is basically the overall implementation of the arm's length principle. This includes 2-3 aspects. One is the arm's length, the benchmarking analysis, comparability, and another is the transfer pricing documentations. So I will talk more about these aspects. This is all on the fundamentals of transfer pricing. I'll talk more in my subsequent podcast. Hope you like this podcast, and thank you very much.